welcome to another MBS Highway webinar. We're joined today with Barry Habib and Dan Habib, as well as Mr. Peter Boockvar. And if you're not familiar with Peter Boockvar, he is the Chief Investment Officer at Bleakley Financial Group, a New Jersey-based $9 billion wealth management firm. He's also the editor of the Boock Report, a macro market newsletter. And prior to joining Bleakley, he was Chief Market Analyst at the Lindsey Group, a macroeconomic and market research firm founded by former Federal Reserve Governor Larry Lindsey. And before this, Peter worked as a macro analyst and portfolio manager for a brief time at Omega Advisors and had previously been a partner at Miller Tabak Company, where he was the equity strategist and portfolio manager. Welcome back, Peter.
Great to be here. Thanks for having me.
Yeah, and you forgot to mention that he's like the Wile E. Coyote super genius and a very, very dear friend. So my brother, it's so great to be with you here. There's so much going on. I know people have a lot of questions. We're going to try and get to some questions. Diana's going to monitor it. But Peter, we always try and give people credit when credit's due, and you deserve so much credit for so many of the calls you make. And I know that Dan and I, we do mention quite a bit some hot tips that are due to you for some great insights. But I also want to mention something that many people don't know is that you were the first person that I remember saying that you see stagflation coming. And when we take a look at the most recent GDP report that we received yesterday, along with today's inflation numbers, combine that with the CPI number that we received, we're almost in the definition of stagflation. So congratulations for that great insight and call.
Well, it's not something that anybody wants to see, but it is the reality. I think what tipped me off and my antenna went up on this whole inflation story was really going back to the shutdowns in the heart of it, March, April 2020. You know, in the United States, when you go to the supermarket, you're used to seeing the shelves stocked with stuff. And it was this very rare thing in April 2020, late March into May, where the shelves in certain supermarkets were bare because you had this flood of demand for food because people were going to eat at home instead of going out for dinner. And that was sort of the first sign that COVID has caused, at least temporarily at the time, this supply-demand imbalance. And then, of course, then it morphed into a lot of fiscal spending and the Fed's response, and then it filtered into other things, and it just took on a whole life of its own. But yeah, it's the world we're in, and it becomes obviously a more challenging type of environment. It's a bit different than the 70s in that, there's no real Webster definition of stagflation. There's no one author of that definition of that word. But in the 70s, the high inflation sort of correlated with a higher unemployment rate, where I think just generally speaking, you can say that it is high inflation married with just sluggish economic growth. And now that we've had 2 quarters in a row of contraction, you can certainly call that sluggish growth if some of you don't want to call it a recession, even though it's essentially one, it is one, and that the third quarter GDP, if you think that trends hold and even extend further, then you'll have probably another quarter of decline.
So Peter, when we take a look at the rule of thumb definition of 2 quarters of GDP, and now that narrative, was out there where we're hearing, for whatever the bias is, whatever the reason is, trying to be changed by the White House or by Jerome Powell, trying to say, or by their head salesperson, Janet Yellen, whether they're trying to change the narrative or not, is undeniably we are seeing a slowdown. Of course, when you can always point to bright spots within a slowdown, right? So this is something that we know. It doesn't mean that everything is completely dead. So you can point to certain bright spots, certainly, but overall, I think we're clearly seeing a slowdown. And not only are we seeing a slowdown, but what you're talking about here is the third quarter GDP not being stellar, maybe even being negative if the trend holds. Then you'd have 3 consecutive quarters of GDP. It's like, we know that the National Bureau of Economic Research has to officially call it. And an analogy that I like to use that we came up with is like, if you have an umpire, that's like the National Bureau of Economic Research. And if a pitcher throws a ball that's right dead center of home plate, right waist high here, it's not a strike until the umpire calls it, right? But it's awfully hard not to when you see a pitch like that. And to me, it looks like 2 and now potentially 3 quarters of negative GDP. Sure looks like a ball thrown right dead center of the heart of the plate there. I don't know how you can't call that a recession. Although, Dan, there are some definitions that they have, right?
Yeah, so the MBER, they really want to see economic contraction that has a certain amount of depth, duration, and diffusion. They also usually like to wait, somewhere in the neighborhood of 6 months after, some economic contraction to really make sure we're in a recession. But, Peter, interested to get your take on some of the comments we saw from people like Steve Leisman on CNBC, wanting to give Q1 GDP, the decline there, the negative 1.6%, a pass or a mulligan because of inventories.
Well, in the back half of 2021, GDP was lifted by an increase in inventories. So we are giving that back, but in the second quarter, if you take out both inventories and trade, so real final sales for private domestic purchasers, there was 0 growth in the second quarter. And the only reason why we're having just generally in the economic world and obviously in the political world for sure about this semantic recession debate is because the unemployment rate is still at 3.6%. And people scratch their head and say, well, how is that possible to have a recession when the unemployment rate is so low? But that is not really understanding history, because recessions begin off a very low unemployment base and expansions begin off a very high one. It's the turn that then happens that then drives you in the opposite direction in terms of economic activity. And if there's a lagging indicator, the unemployment rate is the lagging of the most laggiest, even though it's not a word, economic data points. And if you're a business and business starts to slow, and keep in mind, the economy doesn't just shift like the snap of the finger, like it did in COVID when we just shut everything down. That obviously was an anomaly. Generally speaking, a slowdown, it takes time. It starts in one particular area, and then it spreads to another, and then it spreads to another. And it's a progression of events that takes place that results in the cumulative contraction that the NBER can call a recession. So we are beginning to see that slowdown take place. We're seeing it in obviously the interest rate sensitive parts of the economy, like housing and autos. We're seeing it just generally with people going to the supermarket and trading down from Kellogg's cornflakes to the store brand cornflakes, or they're delaying paying bills like AT&T talked about. So it's a progression of events. Now, with respect to the unemployment rate, if you're a business that's seeing activity slow, you don't just immediately start firing people. You wait to see, well, okay, things are slowing. Let me just pay attention to this. And then if 3 months down the line, things are continuing to slow, we're not getting any better, then you say, okay, let me start tightening my belt. Let me slow down my pace of hiring or stop hiring. And then if a couple months later, things are continuing to soften, well, that's when you start to lay people off. So it's the end part response to what will already be an economic downturn / slowdown that we're now currently seeing. Now, that said, we are beginning to see an increase in the pace of firings. We saw this week jobless claims that came out, and on a 4-week average basis to smooth out weekly bumpiness, it's at the highest level since November. So, okay, maybe some people don't want to call it recession, but the pace of firings is now at an 8-month high, and combining that with already 2 prints of negative GDP, it's, to me, ridiculous to say that it's not, but it is. And just take this globally to really expand it. Europe, which is technically not in one, they actually saw GDP growth in the second quarter. Well, I don't know how they avoid a deepening of their economic slowdown in the back half of this year, particularly with, driven by very high energy prices, where on a million BTU basis, they're paying broadly $60 for natural gas versus the 8 or 9 that we're paying here. And that squeezes not just households who need to cool their house during the summer and will have to heat it during the winter, but European industry, particularly German industry, is hugely dependent on cheap natural gas as a feedstock. And without cheap natural gas, it makes it almost impossible for them to be cost competitive. You look at China. China's obviously had this self-inflicted wound because of how they've dealt with COVID, plus the unwind of their residential real estate bubble, and they're likely seeing no growth at best. So so this economic slowdown is a global thing that's happening, and I think we just have to really more shift the conversation to how deep will it be and how long will it last, rather than are we there yet?
So we'll have a slide up here, Peter, that you could see. This is Fed Governor Christopher Waller, and Fed governors, they're always voting members, so very influential. He says, I can't see a recession with a 3.6% unemployment rate, but you take a look at the actual history of what you had mentioned, exactly what you had said, is that recessions, the darker areas begin not when unemployment rate's high, it's when it reaches its lowest level and then turns upwards with 100% accuracy. And I know, Dan, you had some thoughts on where we are today as well, and the unemployment rate of 3.6.
Yeah, Peter, I wanted to pick your brain on this because I think that, I know you see it this way, but many people don't realize that the unemployment rate, there's 2 surveys within the jobs report, the business survey and the household survey. And the household survey is where you get that unemployment rate from. So in the last jobs report, while the headline showed 372,000 job creations, the household survey, where you get the unemployment rate from, showed 315,000 job losses. But you would assume the unemployment rate would go up, except at the same time, you saw about 353,000 people leave the labor force, which is why for 4 months in a row, it stayed at 3.6%. What I'm really interested to hear is, what do you think is going to happen next week? Next week's obviously jobs week. We know that we're not getting ADP, but we got the BLS on Friday, and they're expecting, last time I checked the estimates, 250,000 job creations, and for the unemployment rate to remain for the 5th month at 3.6%.
Right. So as you point out about those 2 different surveys, now over time, the surveys converge, or they should converge in terms of their calculations, but month to month, they can definitely tell 2 different stories. I think for next week, and before I even talk about next week, just so people can understand that, so the first 6 months of 2022, we've seen a contraction in the economy. At the same time, we've seen pretty good job growth in the establishment survey of 500,000 a month. And people can say, well, how is that possible? Well, what that means is that productivity is falling, because if I'm adding people and producing less, my productivity is declining. And GDP growth is essentially growth in the labor force plus productivity. Yeah, maybe I'm getting growth in the labor force, but I'm seeing if a minus sign in front of productivity, that's how you can actually add jobs and still see an economic downturn. Now, as I mentioned, with the pace of firings picking up, that pace of hirings, of course, is going to slow down a lot, because the company that's not firing, they're going to slow down hirings. And of course, the company that's firing is also going to slow down hirings as well. But then, of course, you have another scenario where companies could be firing here, but then hiring here as they sort of recalibrate their labor force. But also, this is what happens after what was an economic party the last couple of years in technology, where a lot of companies were throwing a lot of VC money. And what do you do with that VC money? You want to go out and you want to hire people. And because you're competing against other companies for employees, you probably overhire. And then all of a sudden, everyone looks around and say, wow, the macro situation is changing here, and I got too many people. And that's what they start to rationalize their labor force. And the nice way of saying firings is people want to call it redundancies of how they want to sort of right size their business, because they need to start focusing on profitability, because they can't keep running at a loss, because that investor money may run out at some point. So next week we should see a reduction in the pace of hirings. a likely increase in the unemployment rate, and we'll just see to what extent.
Where do you think these people that are leaving the labor force are going? We're seeing that. What's happening here?
Well, I think it's tricky in trying to figure out what's going on. I think there's no doubt that with COVID and the shutdowns, you probably had people that 65 and older that were planning to retire anyway, just said, okay, I'm just going to speed up my retirement. So they're not coming back. You definitely have people on an increase in the people that are on disability, whether it's long COVID or some other reason, and they're not coming back so soon. So I would really attribute it to those two things. And you know,
So
the government has.
You don't think it's just OnlyFans, huh? No, I'm kidding.
What's that?
You don't think it's just the OnlyFans growth, huh?
Yeah. Well, and then, you know, also we have very generous government programs that you know, at a certain point of income, it doesn't make it worth going back to work, unfortunately. So I think it's probably a combination of all these factors.
By the way, that increase in labor with decrease in productivity, isn't that almost by definition inflationary?
Yes, because, well, first of all, labor is, for most companies, it's their biggest cost expense, and as a percentage of revenue, and certainly on a dollar basis for sure. So when companies are seeing reduced business, they're seeing higher costs, well, they do try to either cut other costs or they're going to raise prices to cushion that margin squeeze. And that's one thing that we've heard a lot in earnings reports over the past couple of quarters is the margin squeeze on one hand for those companies that have just less pricing power, but the desire to recapture these lost profit margins. And they'll do that through either cutting costs, slowing the pace of hiring, firings, but also raising prices. But yeah, generally speaking, the more productive you are, the less inflation there should be, because you can produce more with less. And the reverse, the less productive you are, you're producing less with more, and that would then raise prices all down the line.
Yeah, Peter, it's so great because I don't know how you found the time to amazingly do this, but you listen to so many of these huge earnings calls. And I love when you break this down in your work where you show, you know, these themes. And it appears from what I'm learning from you, from your research on this, is that one of the expectations from many companies is that they're going to have to raise prices. Is that the sense that you're getting?
Yeah, they because they want to get back to these lost profit margins, and they're going to try to raise prices where they can. And there's try to picture you are making a widget and you're selling that to Walmart. And your production of these widgets, all of a sudden, you have this massive increase in your costs. You have an increase in your raw material costs that go into that finished widget product. You're now paying $12,000 per container to get your stuff from Shanghai to the port here, where you were paying $1,500 before COVID. You're now paying $20 an hour for that college kid because wages are going up across the board, in addition to having to raise wages across the board to others. So let's just say your all-in cost structure is up 35% within 6 to 12 months. Well, if Walmart is your customer, well, you're not calling up Walmart and saying, hey guys, sorry, but I'm going to have to raise the prices of this widget by 35%. Walmart would tell you to go screw off. I'll get it somewhere else. So your costs have gone like up here. And what you're going to do is you are going to try to recapture that lost profit margin, but over time. So you're going to raise prices by 5 or 6%. Then you're going to raise prices by another 5 or 6, then another 5 to 6 to try to get back that jump in your costs. Now, hopefully that jump in cost starts to moderate. So instead of paying $12,000 a container, now you're paying $7,500. So you're getting some easing of pressure there, but you still haven't caught up with your margin, and you still haven't caught up with your price increases. So I think that's why usually an inflation situation that is broad-based as it is, doesn't just go away in a year. Sometimes doesn't go away in 2 years. Sometimes it's the 70s where, yeah, you're going to see a jump in inflation, and then you'll see some give back, and then you'll see another increase. And that's why this sometimes can last more than just a couple of years.
So I want to show a chart here, and maybe Dan, just so everybody watching could just kind of understand it, and then you can ask Peter if he agrees with our thought process on where inflation might go over the next few months, but then into the fourth quarter.
So this is a chart of the Consumer Price Index, and it shows you all of the monthly increases from April of 2021 to current here, June of 2022, the last reading we got. And, we try to explain to people that this is a rolling 12-month report. So when we get the next report, which is going to be for the month of July, we are going to be replacing the July 2021 figure. And there's been a lot of talk out there in the media that, we're starting to see some commodity prices roll over, and many people think that we have reached peak inflation and we'll see it go down from here. So we wanted to get your thoughts on this, Peter. But one of the things that we are keeping our eye on is these summer months from last year, and they were very low comparisons. So you have 0.5% for July, 0.3 for August, and 0.4 for September. So one of the things that concerns us and makes us think that we're not out of the woods on inflation yet is that, we just got a 1.3% reading. I mean, imagine if we got a 1% reading, you could approximately see the inflation rate go up by 0.5% to, getting towards maybe 10% or something like that. So what are your thoughts on that, Peter?
Yeah, I mean, it's interesting to look at it month over month here. Now, if you looked at it year over year, the comparisons do get tougher. I mean, the eventual July CPI is off still on a year-over-year basis in July, off a high level. So, but it's very possible. And again, we have to also keep in mind that the headline number, because it's energy and food are going to be a big driver. So yeah, it's possible that we can print a little bit north of what we saw in June, but that moving piece is energy, and we know we've seen some give back on energy. So the headline number could give back, but at the core, the core rate is still, I think, potential. Well, we've seen some moderation, but the core rate still has the potential of going higher, because any moderation we see on goods prices, which we've seen about 4 to 5 months of a slowing rate of increase in core goods prices ex food and energy. It's been offset though by food and energy, and also offset by an acceleration in services inflation, mostly driven by rents, which make up 30% of CPI, 40% of the core rate, with PC having a smaller contribution. So I think that whether we're at the peak or we're just about at the peak on a rate of change basis, which then begs the question, well, how quickly does it fall? If you were to pencil in 0 month over month for the next 5 months of 2022, by year end, you would still have year-over-year inflation about 7%. So that tells you that even if inflation stops going up, the rate of change year over year is still going to remain pretty high. And then, okay, you go into 2023, how quickly does inflation fall off? And while it will continue, or it should continue on a rate of change basis, we're still in a new world of higher inflation, and it's not 1 to 2. It's going to be 3, 4, or 5 for the next couple of years after things sort of come off the boil over the next 6 to 12 months.
So that's very interesting. So now let's get into the mind of the Fed, if we can kind of go there for a moment here, right? So we've heard the Fed say that they're not that far off of neutral. And I guess that when we do the math, and it's something actually Dan and I were talking about it this morning with Diana, we were trying to kind of see what the Fed might be thinking. So if the Fed is looking at the core PC, we know they gravitate towards that number. So the year over year is 4.8%. Now the Fed funds rate right now is
right of core.
Of core, right? The year over year core PC is 4.8. If the Fed's looking at a Fed funds rate currently between 2.25% and 2.5%, right? Let's just split the difference and say 2 3/8. And then they raise it up towards, let's just call it 3%. are they considering that acceptable is 2% inflation? So they're off by a little bit before what they consider to be neutral. Take us in the minds of the Fed, and what is it that they're targeting or looking at?
Well, it's this is they as much as they want to try to make this scientific, it is very much an art. And Powell in his press conference really conflated the entire concept of neutral, what a neutral rate is. And first of all, a neutral rate is an econometrically central bank made up number that there's no real existence of a neutral rate. It's whatever they think it or say it is, depending on their model. But their model of a 2.5, call it a 2.5% neutral rate, is dependent on. So the neutral rate, for those that aren't familiar, it's at what level of the Fed funds rate would neither accelerate or reduce economic activity. Like, where is that sort of equilibrium cost of capital, in other words? But that neutral rate, one of the inputs into that is a 2% inflation target. Well, Powell on Wednesday said, yeah, we're at the neutral rate of 2.5. Well, no, you're not, because the input of inflation is much higher. Therefore, the neutral rate has to be much higher. So what ideally is their neutral rate is basically a 0.5% real rate. That ideally, if inflation was 2, Fed funds rate's 2.5, that would imply a real rate of a 0.5%. Well, if core PCE, which is, as you said, 4.8, even if it moderates to 4 or 3, well, I think in the Fed's mind, that's where it could moderate to. And by getting the Fed funds rate to 3, 3.5-ish, then they're close to what their neutral rate is. So I think that's what they have in mind. But I also think that they understand, okay, they've shocked us with this rate move, because that's what this has been. It's been a shock. I mean, the Fed went decades just raising 25 basis points. It was rare to see 50, which they did in 2000 when Greenspan took the Fed funds rate to 6 to 6.5. But 75 basis points, you have to go back to 1994. And here the Fed did it 2 meetings in a row. So I think that they are trying to get the Fed funds rate to 3, which they'll do in September when they raise by another 50 basis points. And then at the same time, quantitative tightening ramps up to its max level of 95 billion a month. And then I think they're just going to step back and say, okay, how is the markets, how is the economy handling this? And where are the numbers playing out at? But I guess to your other question, like, what are they thinking in terms of when would they stop relative to where the inflation rate is? I think you can be sure that they will stop well before inflation gets back to 2%. And that I think Powell cares less about the GDP figures and cares a lot more of what the unemployment rate is. Because first of all, they conduct monetary policy. While they call themselves data dependent, the data that they get is by nature rear view mirror. So they conduct monetary policy looking behind them rather than looking at what could be. So GDP contraction, I don't think they care as much. The unemployment rate going from 3.6 to 4, 4.5, 5, that's when they care. Because that's when the political situation starts to change for them too. You know, it was last year when Joe Manchin wrote a letter to Jay Powell and said, Jay, you know, we got an inflation problem on our hands. And then Jay kept on, you know, printing, had rates at 0. When the unemployment rate goes higher and people start losing their jobs and they start calling their Congress people, that's when the conversation will change from inflation's a problem to people are losing their jobs.
So a couple of really important. So first of all, thank you, Peter. That's, as always, wonderful information and knowledge for us. But it brings up something very interesting that one of the brightest minds out there in this arena, and somebody that we're all friendly with and love and respect, is Lacey Hunt. In his letter a quarter ago, not the most recent one, and I spoke with him about this, he brought up such a great point in that, you know, look, we know the Fed lives in academia, right? I know, Dan, you did a whole breakdown showing the lack of experience of all the Fed members outside of either the Fed, or maybe some of them had Fed and academia, or I think there was only 2 that had real world experience. And even that was a bit checkered at McKinsey. But so we know that they don't live in the real world. And they're so focused, as you said, on unemployment. And Lacey's point was so great in that, okay, even though the private sector deserves a lot of the credit for this, but let's just say we're going to give the Fed credit for creating 10 million jobs, which it would have bounced back anyway. But let's just say that's the case. Let's give them that full credit. You've now hurt 170 million families because they're all paying more money in inflation. Why can't the Fed see this? Why can't the administration see this and understand that this dual mandate situation, it's a difficult line to walk?
Correct. And with that difficulty, one of the lessons that the Fed should have learned from the 1970s is you can't maximize the economy and employment if you have unstable prices. That stable prices, a stable currency, is the foundation for any healthy economy. And Powell decided that he wanted to turn the Fed post-COVID into the Ministry of Social Justice. And he wanted to be the head minister of that. And that's why, inflation an issue? No, it's just transitory. We need to get these people back into jobs that have lost them and aren't back yet. Now, I understand, that we all want that. But by ignoring the price side, he created unstable prices to, as you said, the 150 million plus households, to try to bring back 3 to 4 million jobs that have been lost, that were half and aren't coming back anyway. So I think they lost their way. But that's why Powell, for the last couple of press conferences, keeps saying, well, we need stable prices. We need stable prices in order to have a healthy economy. He's completely reversed his rhetoric to the right thing. He's saying the right thing, but unfortunately, he was saying the opposite when they were easing and ignoring the fundamental principle of a healthy economy being stable prices.
Yeah, and they all were. I mean, we pulled up quotes from all of them, Mester and Diana and Dan. You probably remember quite a few that we pulled up. Daly was off the planet. So, all of them. All of Yellen was a big proponent of, we don't stop now. It's too early to stop. All that stuff, right?
There's
I mean, yeah. There you go. There's yeah. So thank you, Diana. But yeah, it kind of underscores a lot of these. And by the way, Diana, I think on that slide, the next slide was to show the inexperience at the Fed in the real world as well. Yeah. If you wanted to just show that real quick, just to underscore that point, this is just the lack of experience from the Fed. And you could just see it there. So many of them, their only job at the Fed, then just their Fed and teaching. And then 2 of them worked at McKinsey. Just for shits and giggles, everybody, Wikipedia McKinsey, and look at the checkered past of McKinsey, involved in all kinds of stuff. Enron, this. So it's a joke, okay? I mean, this is why we have these boom and bust cycles. So let's, okay.
So I just want to just quickly add to that. So when the market sets prices, any price, the price of a stock, the price of a mortgage rate, the price of a 2-year note, whatever price they set, a lot of times that price is not necessarily right, but the market quickly adjusts. And if it's offsides in one way, it quickly adjusts the other way. When the Federal Reserve is price fixing the cost of money, they don't quickly adjust. So when they get excessive in one way, it stays that way. And that creates the boom. And then when they realize their mistake and they need to reverse itself, that creates the bust. Okay, so back to you.
No, but it's so true. And by the way, our other dear friend, John Walden, in his last 4 newsletters, he has been really going over that. And there seems to be a magic rate of return of 2%. And if people don't get at least 2%, they rather spend it than save it. And they'll also invest it in much more riskier type endeavors. And that's kind of where you get into this. So my question to you was that if you do feel, Dan showed that chart, and if you do think that a few things here are happening, headed for recession, if not in one already, which tends to slow things down, destroys demand. If we do have higher rates, gives people an incentive to save. And Diana, you might want to bring up that chart that we have of how what the Fed's trying to do here. And then the other aspect is that, and I'd love to get your take on it, is if you think goods will begin to in the fourth quarter alleviate, and then as Dan demonstrated, the comparisons do get a lot tougher, right? Because we had that summer lull, then they get a lot tougher. And when we see this here, we know that the Fed rate hikes, almost always lead to recessions. But Diana, that one where we got those money bags there, that was what I was discussing.
Oh, yeah.
So yeah, that there. So just play that if you can. So what's inflation? It's too many dollars chasing too few goods. So what's the Fed trying to do here? Well, by hiking, people will borrow less. Okay, so it takes some of the money out, and then we know that by increasing rates, people may now have an incentive to save instead of spend. And then if you think by the fourth quarter goods flow, and then as Dan talked about those comparisons, when you put that all together, Peter, it's our thought process that rates start to get a lot better fourth quarter, first quarter. We'd love to hear what you think, if you think we're on track with that in your thinking as well.
So I think
long-term rates, by the way, long-term rates.
Yeah, I think if the direction of long rates were going to be solely dictated by the U.S. inflation and growth outlook, I would completely agree. I think the one thing that makes it more confusing and sort of muddles the call on the long end is that we are sort of in a global, we went into a global bond bubble together. And I say global because you look at negative interest rates. That was the epitome of a bubble where the ECB, the Swiss National Bank, the Riksbank in Sweden, also the central bank in Denmark and the Bank of Japan, they turned an asset, being a bond, into a liability by holding it. And that I feel like that unwind still has time to go. But I don't know what that will mean for the US 10-year. We've already seen a very sharp rise in interest rates in Europe as the ECB has pivoted. I do think that has played a part in the rise in long rates in the US. Obviously, we've had a back off here. But I don't know the answer to how the 10-year in the US is going to respond to further unwind. What happens if we wake up tomorrow and the Bank of Japan says, you know what, we're getting off yield curve control and we're going to let the 10-year band go from 25 to 50 basis points or 75 or take it off? Well, you're going to have a huge sell-off in the Japanese bond market, which will spill over into Europe, which will spill over to here. Where does a 10-year go under that situation? I'm not sure. We have the Fed that is no longer buying U.S. Treasuries. At the same time, we're heading into recession. U.S. tax receipts are about to fall. The U.S. Treasury is about to issue a lot more bonds. And at the same time, the Fed's not buying anymore. Foreigners have dramatically cut back on their pace of purchasing U.S. Treasuries. And banks are already loading up to the gills in owning U.S. Treasuries. So if we need to find other buyers for long end paper. So I don't know the answers to how a market will respond to these sort of macro factors. But I do think that in combination, it could have a factor. So I said like a couple weeks ago, like I wouldn't be surprised if the 10-year went to 2.5% on where growth and inflation is potentially trending in the US. But at the same time, I wouldn't be surprised if it went to 4% because of these other factors.
Peter.
Whereas opposed to the short end, I'm much more confident the short end is going to be tied to Fed policy, and that I've been pounding the table on buying the two-year note yielding above 3% because I think the Fed is almost done raising short-term interest rates.
So Peter, whether we're in a recession or going into a recession, typically recessions are synchronized throughout the globe, right? We see, more than 50% of the globe in a recession at the same time. Where do you see this from a global perspective? And, if we do have a highly synchronized recession, who's going to pull us out of it? And what does that mean for, the depth and duration of this recession compared to previous ones, in your opinion?
I think this time around, only time will pull us out of the recession. In 2008, 2009, you had China spent the gobs of money stimulating their economy. You also had the Fed that was able to at least try to stimulate along with other central banks. This time around, we don't have much to stimulate because central banks don't have many rates to cut. And would cutting interest rates really stimulate anything? If anything, if inflation's still a problem, if the Fed started cutting interest rates to manage a downturn, but inflation was still at 5%, well, I can argue, well, the 10-year yield would actually go up if the Fed was cutting the short end, because the long end of the bond market would lose control of the credibility of the Fed to deal with inflation. I mean, you're a long end holder of treasuries. All you care about is getting money, getting paid back, and having some return in real terms, not in nominal terms, real terms. So,
and just by the way, just to explain what Peter means by that, real versus nominal, real terms after inflation. You know, you could be getting 3%, but if inflation is this, you could higher than 3, you could be losing money. What you want is a real rate of return after the rate of inflation. Sorry.
Right. So owning a treasury, a 10-year treasury, I know the Fed, I know I'm going to get paid back by the treasury. We have a printing press. You'll always get paid back. But what value of the dollar are you getting paid back in? What real, after, as Barry said, inflation adjusted return are you going to get back? And if you lose faith in the central bank's ability to contain inflation because they're more focused on the economy and the unemployment rate, well, then the long end of the yield curve is just not going to be attractive to you. So I think that that's also going to be a factor in where long rates go. So I know it's not really answering the question because I don't have confidence to know because of these big macro factors that, again, could lead to a 4% 10-year or a 2.5% 10-year.
All right. Well, one of the other ones that you kind of brought up there as another one of these contributing factors is the US dollar. And it has gotten much stronger. And I believe that that has been a contributor to seeing some relief in the longer end of the curve, as people playing the fact that, hey, the dollar is going to continue to strengthen because the US is ahead of fighting inflation compared to many other areas. Foreign exchange players might say, well, I'd like to take that ride on the strength of the dollar. And one of the ways I could do that is by buying things like treasuries, mortgage-backed securities, and you get that effect where they both kind of move similar direction. Where do you think that dollar strength goes from here? Does it continue, and do longer end interest rates continue to get a little bit of that tailwind? Or might there be a reversal, and that could that blindside us, where all of a sudden if foreigners see there's a faster horse for appreciation in their currency, they pull away by selling some of those treasuries?
So I up until, call it maybe 2 months ago, and I like to look at the dollar not as one against everything, but try to break it down amongst its pairs, because it obviously can trade differently against every other currency. So up until 2 months ago, the dollar was really only rallying against the euro, the yen, and the pound. It was rallying against the euro and the yen because the Fed was much more aggressive in tightening monetary policy relative to those central banks. UK started to trade better against that because of the economic slowdown there because of inflation. And then within the last 2 months, that dollar rally started to spread. But before then, other currencies actually traded well against the dollar. A lot of commodity currencies traded well against the dollar when commodity prices were going higher. A few months ago, the Brazilian real was at a multi-year high against the US dollar. The Canadian dollar, the Aussie dollar, the South African rand, all commodity currencies traded well against the US dollar. So just within the last few months, the dollar has rallied against everything. And I think a lot of that has to do with the stepped up aggressiveness in this monetary tightening. Now, yes, we're trading well against the euro because of the gas issue there and the energy problem that they're having. But I would attribute a lot of the dollar rally to interest rate differentials because of this aggressive Fed. However, now over the past, call it a couple weeks, and actually I think the trigger was actually the Swiss National Bank, where not only did they raise rates, and we were not expecting it from a -75, but they raised 50 basis points. And then all of a sudden, a few weeks later, Bank of Canada raises 100 basis points instead of 75. And now the Bank of England next week is going to, in August is going to raise 50 instead of 25. And the ECB surprised us by raising 50 instead of 25. And all of a sudden, these other central banks are getting tougher and sort of competing against the Fed's aggressiveness. So I think that is why the dollar sort of has topped out here. Now, whether this continues, we'll have to see. But I think that if I'm right, and it's really just been an interest rate differential thing, well, I think that is sort of losing its mojo because, like I said, other central banks are tightening now aggressively as well. So if you do see some weakness in the dollar here, or at least it's not going up anymore, that could also influence rates too, because the weakness in everybody else's currencies has created a major inflationary problem. I mean, Europe, yeah, they got problems with energy, and now they have this very weak currency, which is just going to import even more inflation. That's a big problem. So they actually, if they can get a rally in some of their currencies, they can actually see some relief. Now, in terms of where foreigners are trading in U.S. Treasuries, it's gotten really expensive to hedge out dollar exposure here if you're coming from a country with a weak currency against the dollar. So it's become cost prohibitive to sell yen to buy U.S. Treasuries. You're really not getting any yield pickup anymore because of that cost of that hedge. Now, on the other hand, also that weak currency, viewers, you can buy a U.S. Treasury and try to bet on the U.S. dollar, but if the dollar stops going up, I don't know if that's such a good bet anymore. So,
that's the point, Peter, is that I think we've had a little bit of a tailwind in the last month and a half or so from that because of the more aggressive nature of the Fed, and that's helped the longer end. So, is this almost a perfect storm for the summer months where we see maybe year over year inflation rise? The Fed, maybe after September 21st, as you had said earlier, Peter, maybe becomes less aggressive as foreign countries' central banks begin to get more of a catch up there. Does that currency trade flip-flop a little bit and say, hey, maybe we think the dollar is going to get weaker, some foreign currencies get stronger, and then they kind of sell treasuries, and we have a couple of months in late summer, early fall, where we could start to see interest rates here, unfortunately move up before the fourth quarter, first quarter, where we see them heading lower. I mean, at least that's the way we're kind of seeing it.
I think it's very possible. And I just want to add another factor here that can influence long rates. If you were the People's Bank of China, if you're the government of China, and you saw in March the European Union and the US slap sanctions on the Bank of Russia that essentially froze half their money, and you're the Chinese and you own $1 trillion of US Treasuries, you probably went into a panic mode and said, you know what, I cannot be as reliant with these holdings because the US government may wake up one day and freeze my $1 trillion. I don't want that to happen. I need to own less US Treasuries. And it's not just China. It can be Saudi Arabia. It could be a lot of countries that own US dollars, whether it's in treasury form or someplace else, that doesn't want to risk us waking up on the other side of the bed and wanting to sanction that money. You also have, and this is just going to take time, but it is beginning to happen, countries that are not transacting in energy in dollars. So you have now China buying oil and gas from Russia in renminbi, not dollars. You have Saudi Arabia that's now selling oil to China in renminbi and not dollars. And that all of a sudden you get more countries that are trading in their local currencies and less dependent on having to buy dollars to do the transaction. That could create, if you have less dollars, you have less need to recycle that into US Treasuries, and that could be less of a bid from a foreign perspective. So I mentioned foreigners owning less US Treasuries relative to what they have owned. 15 years ago, they owned half the US Treasury market. Now it's down to about a third. I'd argue that percentage is going to go down. Again, at the same time, the Fed is no longer buying treasuries. They're essentially selling them by rolling down their balance sheet. At the same time, banks are already loaded up on treasuries. I mean, the US banking system has essentially been doing QE on top of the Fed by having to comply with the supplemental balance sheet ratios that have been instituted on them post financial crisis. And they're essentially been doing QE too. On top of the Fed. So you take a lot of this away, and that could be another factor on where treasuries go.
Hey,
It's
Peter, I was just gonna shift gears a little bit here, team, with the hours going quick. It always does when talking to you, Peter. But a lot of our viewers here are investors in the equity markets, and many potentially pushed into equities because you couldn't get any return or yield with bonds for many years here. But we're seeing the S&P right now. It's recovered a bit, but down about 14 or 15% from the peak. But as we continue to go into a recession and we see things slow down, I mean, normally you see, I don't know, between 35% declines during recessions. Where do you see the equity markets heading? And of course, I want to caveat this, team. This is not financial advice, but Peter, what is your outlook for the equity market?
although Peter is a great person to be because Peter's done very, very well with his clients for that, and those listening should be clients of Peter's, and we'll tell you how to do that. But Peter, give us some ideas on best places to hide, like Dan was saying right now, or best places to take advantage of what's going on in the future.
So Dan is right. The average bear market, the average, some are down less, some are down more, is about 35% from peak to trough, which, looking at the S&P, would take you down to about 3,100. That's the average bear market. If you have a bear market that's similar to the early 2000s, and then the housing bust, then you go down 50%, and that takes the S&P to 2,400. And then, of course, you can have more benign bear markets. But to me, the downside potential, and it's not a call, because with the influence of monetary policy, who knows where markets go. But I think people should just be cognizant of the range of outcomes, and that nothing is off the table here. When you have 40-year highs in inflation and the most aggressive monetary tightening since the 70s in response to that, you can't rule out any type of outcome here on an economy that has been very dependent on low rates and cheap money. So 2,500, I say, to 3,000 is a downside possibility. So where do you go to hide? Well, I also want to say on the flip side is buying stocks in a bear market is the best time to be buying, because things are on sale. If Walmart became Walmart because everyday low prices, if they said tomorrow everyday high prices, no one would show up. The New York Stock Exchange says everyday high prices and everyone gets excited. They say everyday low prices in a bear market and everyone freaks out. So, but you need cash in order to take advantage of that bear market. So I would hold more than usual cash to be opportunistic and take advantage of that bear market. No one's going to be smart enough to pick a bottom, but if you gradually buy on the declines, I think you'll be much better off when looking out over a 5 to 10 year time horizon. Also, in a bear market, it's the more expensive stuff, the growthy stuff, that is more vulnerable, and we've certainly seen that since the peak in the meme stocks in February 2021. Value stocks, which already have low expectations embedded in them, assuming that you're not getting trapped in a value stock, to me, there's less downside risk there. So there are plenty of attractive value stocks that we like. And I'm also still bullish on commodities generally, energy, precious metals. We were long fertilizers as a play on ag, but I sold them after the spike after the invasion. But I still think that crop prices like corn, wheat, soybeans will remain elevated for the next couple of years as plantings, and particularly in Ukraine, and fertilizer prices getting too high, that there's definitely going to be some imbalances, particularly as we look to next year and we see what this year's harvest is like. But it's going to be a more challenging environment. I mean, the incredible returns we saw the last 10 years, we're just going to have to temper those expectations for the coming 10 years, not just in equities, but also in fixed income. But with fixed income, the bond market is actually giving you interest rates for the first time in a couple of years. So they're also attractive places to actually get interest income for the first time in a while.
So Peter, just a couple of quick things. One, just a quick one. Are there any triggers out there that you could say, oh, this would signal a change? Is it something like, let's just say the Fed says, okay, we're going to pause. Is that a trigger that you think means that maybe this could be a good opportunity, even if it's for a short period of time, to be on the long side of things with equities?
Well, we have to understand that if in a recession, the last couple of recessions before COVID, and even going back to the late 80s, is that markets didn't bottom when the Fed stopped hiking. It actually took more time. And in fact, stocks in certain instances fell even when the Fed was easing. The Fed started easing in early 2001. the stock market bottomed in October '02. The Fed started easing in September 2007. The stock market bottomed in March 2009. So don't just make your buy and sell decision on, okay, when's the Fed going to stop, and double down when the Fed starts cutting. Because if this recession and inflation and stagflationary environment that we touched upon in the beginning still has time to play its course, and earnings are going to be negatively impacted by that, don't rely on the Fed to save you. It's going to take time for this to play itself out.
Peter, a lot of people, I'm sorry, Dan, I'll just get to that in a second. I just want to get one quick thought here. I saw a couple of them. I was looking at the chat, a couple of things on the chat. Just first of all, obviously energy, touchy subject. People have very strong opinions on it. I'm seeing a lot of that stuff come on in the chat. I just want to say this, look, we all want a good environment. We all want things to be, for many, many years, and for our kids and grandkids and future generations to be good. My only wish is that it just gets contemplated in a way that is not drastic. And the only thing I fear is that, we don't necessarily have enough electricity now without brownouts and outages. If we put a lot more on the electrical grid, I just hope that it's done in a way where capacity and demand are contemplated. That's my only wish for clean environment. So I saw a lot on that. The other was some thoughts on how does housing do in recessions. Peter, maybe your thoughts on this. I've got the last 9 recessions. Home prices, according to the best indicator out there, do well and then have done well. One exception was the housing bubble. It's been our contention that the housing bubble led to the recession. The fact that you had demographics, not enough household formations, more homes built than ever before in 2007. And then you had the crazy, fog up a mirror, no income, no asset, no job, 100 LTV, 585, all that craziness, which you don't have now. But yet we are acknowledging that the housing market is clearly going through a slowdown. How do you think the recession, if we're in it or not, plays upon this current housing market?
So to add to what you said about, the 07, 08, 09, like you said, that downturn was led by too much supply. That led to the collapse in prices and the banking system and so on. Whereas now, to me, the housing slowdown is more just on price, and that things just got too expensive. And when things get too expensive, buyers step back. And if buyers step back, the pace of transactions slow. Therefore, a good thing for the housing market would be the slowdown in home price gains. That would actually be a good thing, because lower prices, whether it's lower absolute or a slower pace of increase, that would bring in buyers and reset the housing market. And I always go back to that first-time buyer because, and you know better than I do, the housing market has, if you look at a chain, it's got pieces to that chain. You have the first-time buyer that comes in and they buy it from an owner that wants to trade up. And because they were once a first-time buyer and they bought that starter home, and then they want to sell to the first-time buyer, and then they want to move up. If you lose that first-time buyer, it sort of clogs up the rest of the chain. So in order to bring back that first-time buyer, I think we need to see a moderation in home price gains to allow them to better afford, so they're not renting, where they could rent if they want, but it would make it buying just more affordable. So lower prices to me would actually be a good thing for the housing market and a good reset. But like I said, this is just a price thing as opposed to 07, 08, where it was a supply problem that created the price collapse.
Understood. Peter, tell everybody how they can get more closely aligned with you, perhaps as their portfolio manager, or perhaps just if they wanted to be more closely following you.
Well, if they want to read my daily macro and market missives, they can go to bookreport.com, BOOCK report.com, and they can trial it. And if they like it, they can subscribe, and for a pretty low price. And if they're interested in wealth management services, they can reach out to us and check out our website at Bleakley.com.
I can tell you, everyone, and first of all, being proud to call Peter a close friend of mine, and knowing how brilliant he is, and how successful he's been. This is something that we wholeheartedly suggest you take a good look at for your knowledge, for your own personal. But we really think that that we're blessed to be able to always call you Peter as a friend, as we do. We call each other and we kind of kick ideas around.
I'm grateful.
And I'm grateful too for you to always come on and share your incredible knowledge with our wonderful group of subscribers. You know, we have like 1,000 people on the call today. And this is after being switched from yesterday. So it just goes to show a couple of things, how much respect people have for you, Peter, but also it goes to show what amazing quality and character our subscribers have and how serious they're what's good about the mortgage business. You guys that are listening, you know, your customers are blessed to work with you because you put in the time, you put in the effort, you gain the knowledge. I mean, God bless you guys. You're everything good about this industry is all of you guys. We are so lucky to have you subscribers. So from my end, I want to say goodbye. I'll let you guys sign off and say goodbye too.
Yeah, Peter, thanks.
Thank you, Barry. Thank you, Dan. Thanks,
Always a
Dan.
pleasure.
I really appreciate getting on with you guys and talking shop.
Thanks, Peter. We always learn so much from you. And just one last thing, many people are asking for the recording. It'll be sent to you later this afternoon, and you'll find it under Barry's Insights in your MBS Highway account shortly. So,
and by the way, Diana, you were trying to do such a good job with all the chat stuff. Just Diana is one of the smartest human beings on the planet, one of the hardest working people. You see her on the updates, but you don't even know half of it behind the scenes, how brilliant she is. So she deserves a tremendous amount of credit.
well, I have great teachers, two of you, Dan and Barry, and Peter. I always learn so much from you. I study your stuff every single morning. And
Well,
thanks,
and
man.
Megan will be back, by the way. Some of you were asking. She's on a well-deserved vacation. She'll be back from Europe very soon.
we
Bye,
miss her.
everyone.
Bye, everyone.
Hey, guys.